Great. Thank you, Nate. Welcome, everyone. Welcome to beginning of February, but more importantly, the beginning of 2021. And I know that many of us are glad to get 2020 behind us, but just wanted to make a few comments before we turn it over to Mr. Cramer, our Chief Investment Officer, for the presentation for this first quarter annual market report presentation. Just incredibly grateful for all of our clients. We know that 2020 was a very difficult year, but we had 99% of our clients, just about all of our clients, stick with us through a very challenging year. So we are, like I said, incredibly grateful and very humbled. I do like to point out maybe just a couple of highlights from 2020. One in particular that I think is worth sharing. It's pretty exciting. We had over 101 new clients hire BIP in 2020. And so by far and away our best year ever at the firm. And so again, we really appreciate the high level of engagement of our existing clients that willing to give us referrals and give us introductions. I mean, we wouldn't be where we are today without you. So again, we really appreciate everything that all of you mean to us at the firm. And with that, I'll go ahead and turn it over to Eric Cramer, our Chief Investment Officer, to walk us through a really nice presentation about the markets and several different economic items that we're watching closely for us. Thanks so much.
Thank you, Bill. Thank you, Nate. And thanks to everybody who's shown up for the presentation today. I hope you're going to find it interesting. We're going to go through three different parts of the presentation. The first is the look back, the market recap. The headline there is going to be "The Faithful Were Rewarded." The second part is the market outlook, and the headline is "Let's Talk About Fundamentals." We're going to do our best to separate ourselves from the political environment and talk about the fundamentals of the economy and the markets. And then lastly, we're going to end up with talk about market strategy and try to reduce all of this to 5 key investment themes for what we think you should focus on going forward. So let's go ahead and jump into things. And again, the headline here is "The Faithful Were Rewarded." We're going to go through all different parts of the market, prove to you, in fact, that we were indeed paying attention, and maybe give you more information than you're looking for. There's a number of different elements to go through, starting with a timeline of events. So we'll go ahead and move to that. And I'll offer a little bit of a commentary on how you might want to think about the last 12 months. There was a lot of news, to put it mildly, but I'm going to focus on the economic events in particular. And what's negative, in my view, shows up in red. And then what's positive for investors will be in green. So it's not easy to guess at what would be the negatives for the last 12 months. Starting back at the discovery of the virus, which of course was in 2019, that's why it's called COVID-19, but really began to seep into the consciousness of people. Folks became aware. The news got out. We started to get hints at what the severity might be in 2020. And then there was a surge in the summer, and then another surge in the fall. But let's talk about what's in green. That's what's perhaps more interesting. You had a real confluence of events and policy decisions that got made right at the end of the first quarter, and some of those really stuck out to me. The first is this idea that the Federal Reserve pledges infinite money. And I just don't think I'll ever forget those two words, infinite money, in what that means. But clearly this was a signal to the markets that the Federal Reserve was going to go all in for this. In fact, they also separately used the phrasing "whatever it takes" to try to help. You had fiscal stimulus, which was the CARES Act that was passed, and all of this was happening as weekly jobless claims were exceeding 6 million, which just is such a crazy high number. It's hard to imagine what that was like, but this was just 10 months ago. But that was enough to get the stock market moving back up. What happens with the markets and the economy are a little bit different here, but we're talking about the markets, and those things together help to set the bottom of the V. As things progressed throughout the year, and it didn't take that long before we were back up to where we were, we had a couple of other big policy decisions that got made. And for me, one of the most important ones is that the Federal Reserve decided that its prior inflation targets would be adjusted. And really, it was much more than that. It was the Federal Reserve saying, we know we have 3 congressional mandates, but we're going to not worry about stable long-term interest rates, and we're going to not worry about what happens with inflation. We're essentially going to focus just on the employment numbers. And so this letting go of inflation was really the big deal. What it also means is that they're going to focus just on employment, and we're going to get into that a lot later. Of course, U.S. debt hit its new post-war record as a percentage of GDP. And I say that's good for the markets in so much as it means the government was spending massive amounts of money and collecting less in taxes. So good for the markets, bad for future taxpayers. And then lastly, we wound up the year with yet another $900 billion in fiscal stimulus. So all of this has been extremely well received by the markets, and we actually ended up with a terrific year. So let's take a look at just how terrific that was for different levels of risk with their benchmark returns on the next page. What you're going to see is that fixed income is starting to settle into its sort of what you might call normal level of return, or maybe still slightly better in the last 3 months than we should expect. Actually, it's given up that much already so far this year. But the 0.67% return for 3 months is pretty modest and indicative of the very low yields that we're facing now. So that 1 year number of 7.5% for the fixed income index is almost impossible to repeat unless rates were to fall well below zero, which we don't think they're going to do. So don't look at the last 1, 3, 5, and 10 years as any kind of guide as to what you can expect for the next 1, 3, 5, and 10 years from fixed income. For the stock market, 15.7% for the global equity index for 3 months is really terrific. In fact, that would be a great year. And I borrowed the headline from this time 12 months ago. Last quarter was a good year. So we finished 2019 with a terrific quarter as well. So it was, in fact, the last quarter that really gave us our 1 year return of 16.25%. Again, that's for the global equity index. We had come back from where we were before the dip, but it was the last quarter of the year that really turned this into a terrific year that's roughly double the return, again, that we would expect in any year going forward. So that 10-year number for equities is pretty indicative of what we're going to expect for the long-term number. Again, we're saying 8, and the last 10 years gave us 9. But as you look at this chart, of course, and these are the standard reporting periods that are always used by everybody in the business, you'd have no hint of the pain and the stress that we were under 3 months into 2020. Breaking things down a little bit more, and this is the U.S. stock market. You see in the top right quadrant there what happened for the quarter, and what you'll see is that small cap value was really the place to be. Now, most of you will know that at BIP Wealth, we overweight small cap value. And in fact, if we go back to what we were saying 90 days ago, we made the case for, well, why the stock market could rally very strongly because of all the things that were going on, and why small cap value could do particularly well. It's lagged a bit over the last few years, but when you have this kind of general stimulus, it's not necessarily technology and innovation that wins the day, but this broader rally around the market that can tend to favor stocks that might be undervalued. And well, that's exactly what we got. Small cap value did terrific, well ahead of large cap growth. Now, small cap value is a very small part of the market. So, we do need to overweight it to get our piece of that. If you look at what the overall market did for the year, we're talking about 14 or 15%. But this 20% gap between small cap value and large cap growth was indeed a reversal of what we have been seeing more recently, where growth has led the way. But it wasn't just in the US where we saw that. In international developed markets, we saw that as well. Now, the markets aren't broken up quite the same way in terms of the indexes that are available. We can look at value versus growth, and value did better. And we can look at small cap versus large cap, and small cap did better. So the same small cap value tilt was the place to be. But perhaps the third prediction that we made 90 days ago to come true is revealed on this slide. And that's what you see in the difference between the dark gray bars and the light gray bars. So the dark gray bars are actually the returns that we got. So don't focus on the light gray ones, focus on the dark gray ones. 19.3% for the International Developed Value Index that we're showing here. And what those differences reflect is the currency change. So we said 90 days ago there had been a lot of pressure on the US dollar, and really the Federal Reserve was signaling that it was going to push policies that would weaken the dollar. So these foreign currencies rallied. So to just boil it all down, from the perspective of all of us on the call, US dollar-based investors, a rally in foreign currencies makes our international holdings go up even more. And so that's how we got the numbers in the dark gray that are what all of us on the call were able to enjoy. Emerging markets told the same story. Value did better than growth. Small cap did better than large cap. So small cap value was the place to be. So our tilt towards that was terrific. Now, again, that was a rally in the fourth quarter. We saw hints of it in the third quarter. It's continuing on many days today. It wasn't quite enough to make up for what has been the trend for the year in recent history, but these kind of turns are usually fairly violent when they happen. So we saw the same story there. In emerging markets, in total, when you look at the dark gray bars, was the best part of the stock market for investors in the fourth quarter. As we go through all the different countries that you can invest in, we're showing this in two columns, by the way. There's the developed markets on the left and the emerging markets on the right. You get a sense of just where the returns were for investors, and the U.S. did great, but the U.S. market was not the best place to invest in by far. So just to try to link this back to where you saw what you saw previously on the developed side of the market, the U.S. is one market that we show, and that's around 55% of how we invest your portfolio. All the other developed markets there are added in together, and you have diversified exposure across that for roughly 30% of what you invest in. And then on the equity side, and then emerging markets are roughly another 10, and you're diversified across all of those. But again, maybe the bigger picture here is that when the US dollar is falling and these foreign currencies are appreciating, the US is not likely to be the market that gives you the best return. It has been for a number of periods over the last decade, but certainly was not in the fourth quarter. And we don't think will be going forward. REITs gave us a nice return in the fourth quarter, but there's still a lot of ground to make up. And I want to be careful whenever I'm talking about real estate investment trusts. It's actually a pretty diversified market and doesn't include single family housing. So you can have REITs that are investing in multifamily housing and Class A office space and private care facilities and on and on and on, warehouses, strip malls, you name it. So, it's a big class, and there are lots of opportunities there in real estate. There's still a big question mark out there about what this gradual return to work that we think we're going to see in 2021 will mean for Class A office space. As we're going to get into in a bit, the Federal Reserve is really pushing employment, but how many of those people are going to go back to working in their cube or in their desk when we've all learned how to get a lot of things done over Zoom, such as we're doing today? That's still a question. But we had a great fourth quarter, and you had this nice return that's pretty consistent with the broader markets, but still down meaningfully for the year. And then fixed income, where we wring our hands over 0.5% this way or 1% that way. Yet this is perhaps one of the most important slides. If you look at where we're at right now in green, we can draw some lessons. So the green curve in the top middle of the slide is the one I want to focus your attention on. So at the end of 2020, you could you could go out and buy a 30-year US Treasury bond and lock in about 1.5% per year for the next 30 years. So a meager return at best. The overnight rate, and we show the 1 year here, but the overnight rate is essentially zero. The 1 year rate's essentially zero. You got to give it 5 or 6 years to get much above zero at all. That shows you just how low rates are. Now, part of that is a little bit different from where we were on September 30th, because we've come up a bit, but we haven't come up everywhere. In fact, the Federal Reserve has been telling us that they're going to do whatever it takes, which to a large degree means keep overnight rates at zero until they get a whole bunch of people back to work. So we may indeed see the long end of the curve continue to lift. You know, if you look at the Bloomberg Barclays US government bond index long that's at the very bottom of the page in red, you can see what just a tiny movement upwards in the long end of the curve does to long-term bonds for the quarter. That lift up in rates makes everything you already owned, if it was a 30-year bond, kind of uncompetitive, but a tiny movement caused a 3% loss. So you still had a terrific year in long bonds because, as you can see from the dark gray bar on their, rates are substantially lower than they were 1 year ago, but a little bit of movement can cause a big swing in prices for long bonds. And that's one reason that we don't own exposure to long bonds. So we're very focused on capital preservation with our public market fixed income. But if I had to predict the future, it would be this. The short end of the curve is going to stay pinned right where it is. To the extent that economic policies are successful in putting people back to work and growing the economy and generating inflation, I think you're going to see the long end of the curve move up. And it's entirely conceivable that when we're getting together in perhaps 6 or 9 months from now, the short end of the curve will still be at zero. And the long end of the curve, the new green line at that time, will show rates that are even higher than they were on 12/31/2019. So we could end up with a very steep yield curve. And any exposure to long-term bonds that other investors have at other firms could turn out to be disastrous. If we hadn't made the point already, let's look at all those green arrows and see that all the parts of the market went up that we're tracking in the fourth quarter. If you need a reference for how good really good looks, we've just circled that in green. And as if any of us needed the reminder for how bad really bad looks, you can look at the worst quarters ever. So we didn't set any records this quarter, but we certainly have tested some things in 2020 for parts of the market for the good and the bad. That you'll see poking up there. There's some 2020 records that got set, but we did have a terrific year and we had a terrific quarter. Now let's talk fundamentals, and I'm going to move kind of quickly through this, counting on the fact that each of you is indeed going to get a copy of this to go through. So let's start with the Fed's new priority for full employment. Here's a chart of what the Fed looks at. And what you're going to see here are the gaps. So I'm going to make this simpler in a minute, but we're talking about a gap in the headline employment number. So we need about another 2.46% reduction in the unemployment number. We've got a participation gap. That's how many people are choosing to be a part of the labor force. And that fell off a little bit. A lot of people stayed at home. We're likely to have some more checks go out to people that might need some help. But there's a gap there where we need to get more people participating back in the labor force. It has been moving up, but the Fed is very concerned about moving it more. And then lastly, the employment gap, and that's really a product of the two other things. It's how many people are actually working. So there's really multiple components to this, but let's go to the next slide and I'm going to try to bullet down. The Federal Reserve has said it's not going to stop until it gets us back to full employment. And what does that mean? I think that means 5 million net new jobs. And net new jobs is the way to think about this. Remember that in any given month, you might have 5 million people come out of the employment situation they were in, and maybe 5 million and a little bit more go into a new situation. So there's lots of movement within that. But the net of that is that we need to gain about 5 million new jobs. That won't even quite get us up to where we were a year ago. where really we were probably beyond full employment. Keep in mind that over the first 3 years of the Trump presidency and over the 8 years of the Obama presidency, we were adding about 200,000 net new jobs a month. So if that's the rate at which we're adding jobs, and it's 5 million new jobs that we need to get, if we get back to that rate, and you can see how that those gains have slowed down recently, maybe that takes 2 years. So maybe that's 2 years where you can't earn anything on cash. We're going to be making essentially zero, and the Federal Reserve is going to be pulling out all the stops to stimulate the economy. Taking a look at interest rates around the globe, you had a few different sovereign debt markets. So that's like treasury bonds, but from different countries. You had a few that already had short-term rates at zero. But if they weren't at short-term rates of zero a year ago, they all are now. And so you can see that in the US, we moved the rate down. In UK, we moved the rate down. It's already below zero in Germany and so on. So this really is a global phenomenon. Everybody's trying to stimulate the global economy. But as I said, the US dollar is expected to depreciate relative to foreign currencies. It already has quite a bit. And if you're wondering why that would be, that's because the US is doing one thing that's very different from what you see around the world. And we'll show you that on the next slide. I've shown you this type of slide before. In fact, I was showing it a year ago, but it sure didn't look like this. What we're showing is the size of the Federal Reserve's balance sheet. Now, if we go back in time to the middle of the Great Recession, you can see where the Federal Reserve's historically quite stable balance sheet was suddenly expanded dramatically. This is what at the time we were calling quantitative easing. Okay. And so that went up and then gradually got added to on a couple of the different occasions, QE2, QE3. Then we all got worried about bringing the size of that balance sheet down. It's called the taper. And so a few years back, we were all worried about the taper. But the markets did okay until about 2 years ago. We had a blip in the markets. The Federal Reserve reversed itself, began adding to its balance sheet again. And then here in this past year, did twice as much in a couple of months as it had done in the cumulative prior to that. And I just don't think it got enough press. I don't think enough people were aware. And that's when we became especially bullish on the market. That's when we rebalanced into the dip and bought stocks. So, if you'd been 50% in the stock market is your target, and then we had a 40% sell-off, you weren't 50% anymore. So in March and April, we bought stock if you stuck with it, if you kept the faith, and you got rewarded for that rebalancing. We've been taking profit since then to some degree, of course. But this is what infinite money looks like. Because what happens is when the Federal Reserve puts assets onto its balance sheet, it's pretty simple. It goes to a computer terminal, creates cash out of thin air, goes out and buy bonds. And then all of a sudden the market is flooded with cash. And that's how cash ends up in the economy. They increase the money supply. And there's really no limit on how much of this they can do. And so when they pledge infinite money, what you can know is this. If things are going to get worse again, they can do this again. They can double it. They can triple it. They can quadruple it. There's not really a limit. They can put so much cash out there that the markets are just swimming in cash. Now, that could be inflationary, but they can do it. If you go back and you look at what's happened to currencies as they've done that, and this is just the fourth quarter, what you see is just how much so many of these currencies appreciated against the dollar. What might that look like if the Fed decides to add even more money to its balance sheet? I mean, this is just one quarter here. You can look at 10, 20, 30% more appreciation of these foreign currencies if the Fed were to continue down this path. And so let's look at inflation. It's one of the charts that hasn't really changed that much. So while I'm showing you all these wild changes in the value of currencies, we're not yet seeing inflation. So if the Fed were worried about this, which it's not, that's what they've told us, they'd be quite comforted that it hasn't moved. But what happens when foreign currencies appreciate so much, when the US dollar weakens? It means the next time you want to buy a big screen TV, computer chips, automobiles, anything that's made in any of these foreign countries, you're going to have to use a lot more of those now weaker dollars. So if we're talking about 10, 20, 30% changes in the value of the currency, at what point might that become 2, 3, 4, 5% inflation within the US? Because there's an awful lot that we buy from overseas. So this weakening dollar is very good for the US economy, but in effect, it's importing inflation. We haven't seen it yet, but don't be surprised if this becomes 3, 4%. And if you then look at the fiscal side of things, while we're talking fundamentals, as if we needed another case to make for the stock market going up, let's look at deficit spending. Now, I'm showing 3 different charts here, or 3 different lines on the chart, but really there's one you should look at. I mean, forget the blue, that's where we thought we'd be, okay? Those were projections for the future that were made a year ago. And throw those out the window. That's not what's going to happen. This is deficit spending. This is what we spend each year above and beyond what we take in from taxes. So we had this big spike in deficit spending to rescue the economy, to put money in people's pockets. And then if we look at what's currently legislated, okay, we have the new red solid line and just how that's going to continue to grow going forward. But the reality is that the dotted line is probably what we're going to get. It's represented here by the Committee for a Responsible Federal Budget as the alternative scenario, but it's what I like to call reality. That's truly what's going to happen. There's going to be tax increases that might not happen, other cuts that are legislated that won't go through because of what we're trying to do. So what this means is that we're expecting that we're going to be spending way more than we're taking in taxes, and it's only going to get worse. We already thought it was going to get worse. We thought it was going to get worse back when President Obama was in the office. But there's no long-term solution that's really been proposed by anybody in the last decade for any of this. But what we see because of our current situation is that it's now likely to get a lot worse. Now, you could view that as a positive for the stock market, and perhaps we should. Again, this is going to be stimulating the economy because we're not taking in enough in taxes to pay for all that government spending. So that does tend to stimulate an economy. It raises the question, at what cost? Now, if we quit talking about the annual deficit and look at the next slide for what that means for the total size of our national debt, it's the same types of lines. It's the dotted line there. And we talk about debt held by the public because when the government buys its own debt, we're not really caring about that so much. That's just really an accounting entry. But we're looking now at the size of the national debt by 2050 being essentially 250% the size of our economy at that time. So this is expecting the economy to grow. And as you see from the blue line, we knew it was going to go up already, but it got a lot worse than what we were talking about last year. And if you look at the reality of how policy decisions get made, it's really going to run away from us. Now, what does this mean that's negative? Well, when the government is borrowing this much money from who? From you, from investors, from all of us. At some point, especially if inflation has picked up, might they have to pay a whole lot more to borrow your money from you? So it's a bond investment for you, but it's borrowing for them, right? They might have to pay a lot more. So when we talk about interest rates taking off, that's what that means. And this is yet one more contributing factor to the idea that long-term rates could go up, and at least in the short term, while overnight rate stays at 0. So, man, if you own some long-term bonds, you better be ready to lose a lot of money if that's what we see. Now, that sounded kind of dire about your portfolio, but you can manage away from that, and we'll get into that. Let me continue on the positive theme for the markets. You know, the depreciating dollar is stimulative to the stock market. The fiscal stimulus, all that government spending is stimulative to the stock market. Quantitative easing is stimulative to the stock market. And look how it's been working. These are retail sales. There was a hiccup. It's over. It was over a quarter ago. In fact, it's just continuing to grow at a very rapid rate. So retail sales are in fact booming. And surprisingly, this is happening while the savings rate in the US is going up. People are saving money, their stock market portfolios are flush. A lot of folks are making more money than they were making last year. And so the spending is just going great guns. So we have a boom in retail sales. We also have a terrific housing market. If you own a house and you're looking to sell, it's definitely a seller's market. But residential construction is doing its best to keep up with a huge amount of demand. So new homes sold is really being constricted by supply, but is still up. But permits are really taking off. And it's going to take the industry quite some time to catch up to this booming demand. So we're not just seeing a boom in retail sales, we're seeing a boom in the housing market. So as many transactions as supply will allow to happen, new homes being built everywhere builders can find the land and the labor and the supplies to do it. But a true boom here, and in fact, and I'm not really illustrating it here, prices are taking off. So if you need more evidence for inflation, I can show you some slides next time about what's happening with the prices of single family homes, but there's very definitely inflation in that market. And then auto sales are booming too. And what I'm showing you here is the number of days of supply. So, a month ago that was 75. Now it's only 70. A year ago it was 85 days worth of supply. So there is good news if you're looking to buy a Fiat. There's plenty of those. There's even a lot of Dodges, although the pickup trucks are a little bit in short supply. But if you're looking for a Lexus, a Land Rover, a Mercedes-Benz, a BMW, a Jaguar, and hey, GMC is in there as well. Toyota's in there as well. You're probably going to have to take the price that the dealer has got as their MSRP, or you might even have to pay a little bit more. There is a lack of supply. Now, a little complication to that story. The automakers can't get enough parts. They can't get enough computer chips in particular. You've actually got some lines shutting down because there's so much demand for electronics that the computer chip makers can't keep up. So it's still all booming, and it is still all inflationary. So last bit of positive news in terms of what indicates just how strong the economy is and why the markets have been doing so well, and I think will continue to do well. And inflation is, look at this. This is the cost of shipping containers that Chinese ports are facing. They've got so much goods, they can't even get enough containers. They've got so many orders for sales, they can't get them all out of their ports. So the cost of these standardized containers, it's multimodal transportation. You see it on the ships, you see it on the trains, you see it on the semi trucks going up and down U.S. highways. It's those standardized shipping containers that we're talking about. The price is skyrocketing, so it's inflationary. It's going to cost more to get these things. But if you weren't convinced yet, maybe this will convince you just how strong the global economy is and what we can expect, and why that's probably a good sign for the stock market. So let's reduce all that to 5 key investment themes, and then I'm going to kind of wrap up with a couple of different slides. I'm gonna hit the 5 themes real quick. They won't be a surprise, and then I'll sort of give you the main reason why. Public fixed income could suffer. Now, we've got a plan for what to do here to preserve capital. We're working very hard on that. We're not invested in the index per se. We're not invested in long-term bonds, but it could suffer because inflation may be higher than bond yields. So if you were to invest in the index and you were going to get optimistically 2% yield, but inflation's 3%, well, you're losing 1%. You might be losing on price, but just the yield alone might not be keeping up with inflation. So do you sit in cash at 0, or at least try to make 2 in fixed income? Again, we've got a strategy to do the best we can, but the truth is, if we see this runaway inflation, that really we might not even be able to keep up with it. Nobody will be. Stock markets could benefit. Monetary stimulus, fiscal stimulus, infinite money, whatever it takes. All those charts, shipping containers, all those types of things. I think I made the case for that pretty well. Extreme volatility at any time. I've said it for years, always want to prepare people. And the truth is, the first part of this presentation was about, investors who kept their faith benefited. Every time there's volatility, we have a couple of people shake loose. They're scared, they're worried, they've read an article somewhere, they're not sure the markets are going to come back. But I want to prepare everybody for even more extreme volatility. We had a pretty good dip in 2018. We bought on the dip and then took profits. We had a pretty good dip in 2019. We bought on the dip, and then as it rallied back, we took some profits. We had a huge dip in 2020. We bought on the dip, and as it rallied back, we took profits. So buy low and sell high is a pretty good theme for how to invest. But the markets are having to do some new math. I showed you some stuff that we've never had to encounter before. And as the markets try to figure out every day how to do that math about inflation, currencies changing, and all these types of things, I think we all need to be prepared for that type of volatility again. So you want to be at the level of risk where we can buy on the dip, and then as the markets rally, we'll take some profits. Again, buying low and selling high is a good plan. Private markets can play a larger role. Well, there's an awful lot of people here where I don't have to say much about private equity and venture capital, and a lot of our clients have benefited from that, and a lot of folks are going to be getting some more checks here in a few more days from some of their investments. So I don't think that's a tough case to make, but maybe I'll make the case on private fixed income, something that we've not done as much in historically. And again, you used to be able to make a pretty good yield in public fixed income, but if we're forced to endure some pretty low rates in the public markets, then you might be able to benefit from the effort that we've been at for a bit now to try to bring more private fixed income to you. So again, maybe the fixed income index in the public markets would be generous to give us 2%. We might be looking at things in the private fixed income market that can be yielding 8, 9, 10% or more there with the senior secured debt. So a really big gap in what the private markets can offer versus the public markets. Again, you got to be ready to tolerate illiquidity, but if you can, then maybe it can play a larger role than it has in the past for you. Lastly, tax rates will increase. I mean, there's a logic for it there that is pretty self-evident, but I think somebody's got to pay for all of this government spending. So think of it this way. If we're all going to look at higher tax rates going forward, and different people will pay at different rates, the best hedge is to manage your portfolio wisely. The best hedge is to enjoy these market returns that are the result of this government policy that's generating the debt, right? What you wouldn't want to do is sit in cash, not participate in any of this market movement that's to your benefit, and then still face higher taxes in the future, right? So if we're all going to look at these higher taxes and the next generation is going to look at the higher taxes, then we want to make sure we're doing the very smartest thing we can with their portfolio so there's money there to pay for it. So to just remind you of the three big kind of themes that came out today, remember that the stock market is resilient and maybe not as political as you might think. So we've really focused on the fundamentals here, and I would encourage you to think of what happens as the stock market is the net result of some basic human nature. It's an investment in capitalism. It's not an investment in a political party. Okay, it's an investment in capitalism that's fueled by innovation and human ingenuity. And as long as there are capital markets that participants can choose to invest in or not, and pick their trades and pick their prices and so on, then that's what the stock market should continue to reflect. So again, perhaps it's comforting to let go of some of the political thoughts from the past year. Focus on the stock market as a measure of human innovation and ingenuity. Fundamental analysis of the capital markets can be very revealing in the short run. We've got our long-term estimates, and we're not making a change to those. We release those kind of mid-year every year. But in the short run, looking at the fundamental analysis can perhaps give you some comfort. And again, whether it's infinite money, that's one that rings with me, or whatever it takes. There are things going on there and with shipping containers and all these other things that I showed you that I think can really inform what's the best thing to do. And as I said before, get yours, especially if you're worried about the higher taxes in the future. I think we each have a responsibility to ourselves, and we have a responsibility to you to make sure that you're able to get your piece of this.